Okay, dear students, this is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, your F6 TX trainer. Before we start this revision class, let me share some good results with you. Let me share some good results for you just for your motivation. Okay. And good news is that this time we have two students scored world top. You can see that these two students, Mahim Zubair and Uruj, they scored world top in F6. Plus, we have some nationwide position holders as well. We have Saudi top this time and Qatar top just 2 hours before I got this news about these two more positions. So just for your motivation, such a long list for you. This is list one and this is list two. See, it's a huge volume, huge volume. So when these students can do, why can't you? Why can't you? They were all normal students. They studied the same in the same style as you are doing. Same lectures, same teacher, same strategy, everything is same. So first of all, do not hesitate. Don't get yourself confused. Be confident. Treat yourself as a winner. There are students, they think that if they can't do just 2 marks of a requirement, they get demotivated. Out of a 20 marks question or 15 mark question, if they do like 3-4 marks mistake, they say we can't do anything. Still you are getting 11 marks. Okay, so think positively. Your first target is to clear. Your first and foremost target is to clear in the first attempt. That's the biggest success, honestly, right? So let's move on. You know, this is your paper format. The section A, 15 MCQs at the rate 2 marks each, 30 marks. Section B, 3 OT cases, MTQs, the dangerous area. I will tell you why I call this area dangerous area. 30 marks, right? 10 marks each. And then you have 3 constructed response questions, 1 at the rate 10 marks and 2 at the rate 15 marks. Okay. Passing rate is pretty good, around 50, or sometime it touches 52, 53% as well nowadays, right? Now, let me share some tips with you. Although you guys know a lot of tips already. First thing is, as this paper is of learning, so must make exam folder. Even I made a video, I took interview of that student who scored world top, and she shared her experience that she made exam folder, she made the short notes, and she pasted on the bedroom, on the walls, everywhere. So everywhere she could see F6 things. So in this way, as the paper is all about recalling, it's all about learning small concepts. Okay. But for you guys, one good news is, from this attempt, there is no basis period area. Previously, there was a technical, boring, lengthy area with the name of basis period calculation. But now in UK tax, complete UK tax, from F6, P6, ATX, from everywhere, that basis period has been removed. Okay, so this is a good news. But yes, with this new fiscal year or new financial year, they have introduced some more things in corporation tax. Yes, this time your corporation tax is a bit lengthy. This time your corporation tax is bit lengthy. So yes, you need to learn more things in corporation tax. You need to look at corporation tax in detail, right? Next thing is read technical articles. Definitely, we always recommend examiner report, especially the articles for value added tax, CGT. There is one more article of tax planning advances with the name of advanced skill, very relevant. Then you should solve exam kit, past papers. Definitely, one thing, for F6 paper, you should not solve past paper from the internet. They all are outdated, right? But yes, you can solve from ACCA study hub and your exam kit is relevant. Then recapping with your friends. You already know this thing. Okay, now be careful with the OT cases, because OT cases is like a gamble. OT case is like a gamble, right? So if in one OT case there is a 2 marks MCQ and there are 4 options of true and false, true and false, true and false. So if you do one wrong, complete 2 marks you will lose. Complete 2 marks you will lose. Okay. So be careful with the OT case thing, right? Then when planning for preparation, go for cash obvious marks. Like, there are some areas in the chapter you already know. that they makes around like 60-70% of the course. CGT, IHT, VAT, then corporation tax, capital allowance, and NICs. NICs. If you do these areas, you can get a major chunk. You can score major marks. Okay. Yes, read claims date from exam kit. You know, in the beginning, in the starting of the exam kit, even in my classes, I have directed you guys, I've showed the live exam kit in my classes, that there is in the starting area there of the exam kit, there are 3 to 4 pages in which the dates, the claims date and the penalties date are written. Must learn, must read them 4 to 5 times, because this normally comes for 2 marks, 1 mark, 2 marks. So it's better you score those marks, right? Then always read the guidance notes in the requirement. Hope you remember, you have seen the classes, you have seen the exam kit. In the exam kit, with the requirement, they give you guidance note. They say that start your working from profit before tax, start your working from operating profit before tax, or something like that. So read that requirement also. Okay. Small working can be done on the main sheet. Yes, if there is a detailed working, you can do a separate working reference. I'm asking for section C. But if it is a small working, you can do in the bracket in front of the main sheet. Okay. For theory, write each point in a separate line. That's for a marking thing. That's for marking thing, so that examiner can mark it easily. Marker can mark it easily. But you already know, in taxation, it's not a theory paper. Majority is a practical thing. Majority is a practical thing, right? Okay. So although our objective of today's class is CGT, chargeable gain tax, but before we move on to CGT, I'll discuss a little bit on income tax computation. Okay, so that it will also be recalled. Okay, so stay confident. Think like that you are doing preparation for examination. You are recalling things. Okay, so stay confident, stay quiet. Now, you know, three things in the tax, three major things in the tax. Number one is incomes calculation. One thing I forgot to announce, that we have made a WhatsApp group. So the link of the WhatsApp group, my admin has sent in the chat box. So those who are already not on that group, they can join. They can click on that WhatsApp group link and they can join it. Okay, it's pet for you. So you can get more things. Now, you already know there are three major things in the taxation paper. Number one, incomes calculation. So whenever somebody asks you to calculate tax, in return you will ask, what are your incomes, so the first thing is incomes calculation. Okay, second thing is tax calculation. On that income you need to calculate tax, and the third thing is tax payment. So these are the three things on which your taxation course revolves: incomes calculation, tax calculation, and tax payments. Now, for incomes calculation, these are some famous income. See on the right hand side, these are some famous income you can see: property income, employment income, trading income, interest income, dividend income, capital gains. Very famous incomes you can see. So be careful. Yes, for property income we make P&L, we make proper P&L for property income. For employment income we make proper P&L, salary less allowed expenses, and so on. For trading income, yes, there is a P&L. For capital gain, yes, there is a small short P&L as well. But for interest income and dividend income, there is no P&L. For individuals, interest income and dividend income, there is no P&L. Why? Because there are no associated expenses with these things. Okay, they are simply direct income. So in the question, if you find interest income or dividend income, you will pick it up and you will be directly posting in the non-saving interest dividend column, right? Okay, in the main tax sheet. That's how it works. One more thing, that is fiscal year. One very important thing is, my dear student, fiscal year. You already know fiscal year starts on 6th April. Fiscal year starts on 6th April and it ends on 5th April. 6th April to 5th April. 6th April to 5th April. And yes, fiscal year is the time period for which individual pays tax. Very famous lines. Individual pays tax for fiscal year. Individual pays tax for fiscal year. So you better know the meaning of fiscal year. And in my classes, I normally say this dialogue very a lot, that whenever you find the name of individual like Mr. X, Mr. Y, Mr. Ali, Mr. Hamid, so automatically fiscal year will come in your mind. Automatically fiscal year will come in your mind. Okay. Now, moving towards the next slide. The next slide says, see, this is the main format of income tax computation. Whenever somebody asks you to calculate income tax, these three for individuals, these three columns will automatically come in your mind: non-saving, interest, and dividend. So in non-saving, you have trading income, employment income, property income, yes, pensions also, pension income if there is any. Interest income will go in the interest column, and then dividend income will go in the dividend column. You will add these three income. First of all, you will get total income. First of all, you will get total income, right? From this total income, you deduct interest paid. We call it qualifying interest paid. Qualifying interest paid, if it is given, okay? Then you will get net income. You will get net income. On net income, listen, students. On net income, you will be applying breaks. You will be applying breaks on this net income. You will be applying breaks on this net income. Now, this net income you will take here on the side working. Okay, this is the side working. From net income, you deduct maximum two things. From net income, you deduct maximum two things. Maximum two things. Number one, gross gifted donations. And the second thing is gross personal pension contribution if they are given. So you will get ANI, adjusted net income. Now, what is ANI? Your personal allowance is dependent on ANI. The whole personal allowance is dependent on ANI. And I know you better know the rates. If your ANI is between 0 to 100,000, if your ANI is between 0 to 100,000, 0 to 100,000, then your personal allowance will be fixed 12570. If your ANI is between 100,000 and 125,140, then you will have to reduce your personal allowance gradually. And if your ANI is more than 125,140, then your personal allowance will be zero. Then your personal allowance will be zero. Okay. So finally, you will calculate personal allowance and you will fix here. You will fix here personal allowance. You will get taxable income. You will get taxable income. Okay. Now, taxable income is the income on which we directly apply tax rate. Taxable income is the income on which we directly apply tax rate. Okay. One more dialogue I would like to say, very famous dialogue. Whenever you need to check the status of the taxpayer, you need to check through taxable income, not any other income. The taxpayer status is to be checked through taxable income total. And yes, there are three types of tax status: basic rate taxpayer, higher rate taxpayer, and additional rate taxpayer. Okay, right? One thing keep in your mind, we are not taking a normal class, we are doing revision. We are doing revision, so we won't be able to repeat or things, right? It's a revision class. So you can see, yes, the class is being recorded. Don't worry, the class is being recorded. See, you have things in front of you, which I've just told you. It's all. So these are the tax rate for non-saving, interest, and dividends. Yes, these tax rates will be available to you in the exam, but nobody, I think nobody sees these tax rate because everybody knows about a lot. You have done a lot of practice. One more thing, individuals tax bands are extended because of two things. Individuals tax bands are extended because of two things. Number one, gross gifted donation, and the second thing is gross PPC, that the thing which is linked to personal pension chapter. Okay, right? So these are your normal bands. These are your bands 0 to 37,700 and 37,700 to 125,140. But yes, if there is any extension, you will extend these two bands. You will extend these two bands. Okay. Now, what is the tax computation order? Whenever you need to calculate tax, always first calculate tax on non-saving income. then interest income, and then dividend income. First non-saving, then interest income, and then dividend income. Okay. Now, with interest income, there are two major things. With interest income, there are two major things. Listen very carefully. If, let me move the screen. Let me move the screen. There is a little lag of screen. Yes. If this total, see this, if this non-saving income final answer, see the non-saving column. If the non-saving income column final answer is more than 5,000, then you will make a normal band allocation of 0 to 37,700 and 37,700 to 125,140. And in that case, interest income tax calculation will be two steps. Interest income tax calculation will be two steps. First NRB, then normal tax. First NRB, then normal tax. Also, interest income NRB is dependent on taxpayer's status. If the taxpayer is additional rate taxpayer, then 1,000 interest income NRB is available. If the guy is higher rate taxpayer, then £500 interest NRB is available. If the guy is basic rate taxpayer, then, sorry, I have said opposite, sorry. If the guy is basic rate taxpayer, then 1,000 interest income NRB is available. If the guy is higher rate taxpayer, then 500 interest NRB is available. And if the guy is additional rate taxpayer, means very rich, then no interest income NRB will be available, right? Okay. Now, but if this non-saving income column final answer, is less than 5,000, this answer, see students, if this answer is less than 5,000, then in that case, you have to do a band distribution in a different way. The band distribution will be now 0 to 5,000, and then 5,000 to 37,700, and then 125,140. And in that case, your tax computation order will be, see the screen, please. In that case, your tax computation order will be 0 to 5,000, 5,000 to 37,700, and then 37,700 to 125,140. Okay. And in that case, how you're going to target your interest income? First, you will solve this 5,000. First, you will use the 5,000 0% band, then interest income NRB, and then finally the normal tax. These are the three steps in this case, which I'm telling you. Okay, right? So be careful with these two cases. These are the two things which normally students do mistake. Now, how to calculate dividend income tax? Very easy. For dividend income, always first NRB, then normal tax. And dividend income NRB is fixed 1,000 irrespective of your wealth, irrespective of your tax status. Okay, right? This is how we do it. One more famous dialogue: we never stretch this 5,000 band because of gift aid and gross PPC. Okay, the small band of 5,000 we never stretch, we never extend. Only 37,700 and 125,140 is stretched. Okay. Now, I hope you remember this topic: transfer of personal allowance between spouses, married couples, and civil partners. Transfer of personal allowance between spouses, married couples, and civil partners. Yes. For example, if husband or wife has some unused personal allowance, that means the total income is less than 12570, can the husband or wife transfer the unused personal allowance to another spouse? Yes, it is possible. But with some conditions. These are the conditions. First thing, both of them must be basic rate taxpayer. This is the first condition. Both. Number two, there is a fixed amount which can be transferred, and that is 10% of the normal personal allowance. 10% of the normal personal allowance, 12570 multiplied by 10% is 1260. Okay, can be transferred. The last thing, The person who is receiving the personal allowance, definitely one party is giving, surrendering the personal allowance, and the other party is getting, claiming the personal allowance. So the person who is receiving this personal allowance will not increase his actual personal allowance, but will reduce his or her final income tax liability by 1260 multiplied by 20%, that is 252. That means the person who is receiving the personal allowance will get the tax benefit in the end, in the final step of income tax liability like this. Okay, so these are the conditions. Don't forget this topic sometime comes in the MCQs as well. Okay, finally, we are moving towards the real topic for which we are gathered today, the CGT. You guys know CGT is only on chargeable assets. There is no CGT on exempt assets. Okay, these are some exempt assets. You can see certain wasting chattels are exempt, inventory is exempt, because inventory is a thing which is bought for routine resale, you hope you remember the chapter badges of trade. So when it is routine resale, so it's your trade, it's not your investment. Government securities, guilds are exempt. Individual saving accounts, NISA, new individual saving account, cars are exempt asset. Qualifying corporate bonds. Similarly, principal private residence, one residence for yourself is exempt. Okay. Then one dialogue, when CGT is due, like what are the hints you will get in the question, then you will calculate CGT. So this is the requirement. When a chargeable asset is sold, if you are selling it, is gifted, if you are gifting it, still you need to calculate CGT, or it is damaged or destroyed. So these are three famous dialogue. It's sold, gifted, damaged, or destroyed. In that case, you need to calculate CGT. Now, my respectable students, moving the slide again. This is basically the format. This is basically the format of gains. You will write disposal proceed less allowable cost, you will get chargeable gain. Then once in a fiscal year, once in a complete fiscal year, you will add all the gains, and one time you will get one allowed thing is that is called annual exemption, which is 6,000, and then you will get taxable gain. Okay, so now be careful with the revenue receipts world, the non-saving interest dividend world. Remember the world. In that world, you will be getting personal allowance, but in this CGT world, you get annual exemption. There are some differences. Yes, personal allowance may vary according to your ANI, but my beautiful students, CG annual exemption, you don't change it. It's fixed number. It's not dependent on any ANI or something like that. Okay. Now you can see the format I have written: disposal proceed less allowable costs. Now, what are the allowable costs? Definitely original cost of purchase is full-time allowed. Then legal cost to buy or sell that chargeable asset or fixed asset is allowed. Then improvement or enhancement in future, if you have done any, it's also allowed. But repairs and revenue expenditures are not allowed in this world. Repairs and revenue expenditures are not allowed in this chargeable gain tax world. Okay, so these are the tax rate. There are three types of gains. One is RPG, residential property gain. Other is NG, normal gain. The third one is QG, qualifying gain. Listen. I sometimes say normal gain is a residual category. This NG is a residual category. First, understand RPG. RPG means residential property, the property which can be used for residential purpose, not You are using it. It's not the condition, but it can be used for residential purpose, means the property of residential area, right? If you sell it, the gain will be RPG. Now, what is QG? QG means qualifying gain, the gains which meets the condition of BADR. BADR, business asset disposal relief and investors relief. Business asset disposal relief and investor relief, then you get flat 10% tax, okay? And the rest, other than RPG and QG, other than RPG and QG, all the gains are normal gain. Okay. So what are the tax rate for RPG? 0 to 3, first band is 18%, second is 28, NG 10 and 20, QG flat tax rate of 10%. For QG, there is a flat tax rate of 10%. Now, my dear student, what is the order of tax computation now in a question which contains everything? This is the order. Always calculate tax on non-saving income first, then interest income, then dividend income, then QG, qualifying gain, and finally RPG or NG in any order, no issue, no issue. Now, order of utilization of annual exemption. Annual exemption, and also I say losses. Annual exemption and capital losses, how to utilize it? Definitely you will utilize it with the gain with highest tax rate. So always use annual exemption in front of RPG first, then NG, and then finally QG, then finally QG. Now, my respected student, there is a topic which we call business relief. There is a separate area in your course which is called business relief. Business relief. Okay. So the business relief area, there are many relief like BADR. Then you have rollover relief, frozen gains. You have gift relief. These all is one chapter. Okay. So let's start with business asset disposal relief. First of all, this relief is only for individuals. It's not for companies. Okay. And you only qualify for business asset disposal relief when you do material disposal of business assets. Now there are two major tunnels, two slides. If you go on one slide, you will go to your destination, okay, of this BADR. So the first tunnel is, see, if you sell your running business, or part of running business, okay, running business means ongoing concern basis, and you hold that business for last 2 years, you have ownership in that business for last 2 years, yes, you are eligible for BADR. So this is the first tunnel. Okay. The second and very important tunnel is sale of shares. What are the conditions? See, you are selling shares of a trading company. Trading company means not for profit organization. It should be a profit organization. The objective is trading. Number two, your holding must be greater than 5%. Number three, you must be employee of that company. And the fourth condition is 24 months holding period of these shares. So if you meet all these conditions with shares disposal, you will be eligible for BADR. So these are the two tunnels through which you qualify for BADR. Now, there is a claim date for BADR. There is a claim date for BADR. And that claim date, if you get a qualifying gain in 23-24, then your claim date is 31st January 2026. What do you mean by this claim date? Definitely, it's not a mandatory thing. These all reliefs are optional. So how will government come to know that you need the particular relief? You need this particular relief. So you need to speak up. You need to write to government. You need to say government that we need this type of relief. Okay, so there is a due date for this thing. Now, next, and a very small relief is called investor relief. If you use your brain, for BADR shares route, you must have to do the job in that company. So job means only internal employees can claim. So people requested government that please extend this relief. So government extended it. Yes, one thing I forgot. For BADR, the lifetime limit is 1 million gains. Only 1 million means 10 lakhs. 10 lakh. Okay. Only in your whole life you can claim 1 million. You can claim BADR on 1 million gains. That's it. then your limit is over. Now the next thing is investor relief. This is for external investor. This is for external investor. This is for external investors. Okay. So now you don't need to do job. By the name it says shares of unlisted trading company, unlisted plus trading company, subscribe for. That means you didn't buy these shares from any friend or any market. No, you have to directly buy it from the company. Company issued the shares, subscribed from newly issued company after 17th March 2016. That means company must have given you shares directly after this date. Then holding period is 3 years now, and this holding period must be after 6th April 2016. Okay, you must hold it. No need to do job in that company. Now there is no requirement. Now, if you meet all these conditions, you will get the same good news. Once you sell these shares, this gain will be qualifying gain. And on qualifying gain, you get a flat 10% tax rate. One more good news here. For BADR, the lifetime limit is only 1 million gains. But for this investor relief, the lifetime limit is 10 million gains. The lifetime limit is 10 million gains. Okay. So this is much better. Now the next relief is business relief, that is for your reinvestment. I hope you remember, government really wants you to reinvest in business. If you sell an existing business asset, don't spend the proceeds on your family. Don't eat up the proceeds. It's better you reinvest. If you reinvest, it's good for the economy. It's good for the country's GDP and everything, business activities. So both of these are connected relief. Rollover relief and frozen gains. In both of these reliefs, you normally sell an old asset and you buy a replacement asset. You sell an old asset and you buy a replacement asset. Okay. So in both cases, your gain is deferred. Gain is deferred, not an exempt permanently. It's just a deferral. Both reliefs are deferral relief. But see, there is a difference in rollover and frozen gain. In rollover relief, your base cost, the base cost of the new replacement asset is normally reduced. Okay. So if the base cost of new replacement asset is reduced, automatically, whenever you sell that asset in future, your future gains will increase, and this means deferral. This means deferral. But in frozen gains, you never reduce the base cost of replacement asset. You never reduce the base cost of replacement asset. Instead, you freeze the gain. You put the gain in the freezer. And this gain is in the freezer till 3 events. There are 3 events. You open the freezer and you pay the tax. And those 3 events are the disposal date of new replacement asset. Number 1, earliest of 3. Second thing is maximum 10 years. That's the maximum time. And the third thing is the date on which you stop using the asset for business activity. Mark these 3 dates, and whatever the earliest date is, you need to open the freezer and then you have to pay the tax. So this is the difference between these two. So I would say it again last time, that don't see the old asset, always see the replacement asset. See the difference. If the replacement asset is a non-depreciating asset, then do rollover relief. And if the replacement asset is a depreciating asset, then do frozen gains working. That's it. Now, what are the famous depreciating asset? What are the depreciating asset in our course? Plant and machinery. And the second is leasehold property with lease term 60 years or less. I sometimes say my student learn these 2 names. If these 2 names are coming for the replacement asset, then do frozen gains working. If dear student, if it is written other than these 2, if the replacement asset is other than these 2, then you can do rollover working. One more summary slide you can see. The next slide is again for summary. See, for rollover, replacement asset must be non-depreciating. For frozen gains, replacement asset is depreciating. Okay. For rollover, base cost of the replacement asset is reduced. For frozen gains, never reduce the base cost. Now, the next relief is called gift relief. The next relief is called gift relief. Let me give you a little logic so that you can taste this relief as well. Just think, for the first rule is, in the CGT world, if one person transfer a chargeable asset to another person, the transferor, the guy who is transferring the asset, must compute gain even if he or she is not charging anything. In that case, you will treat market value as DP. In that case, if the DP is 0, you will treat market value as DP. Okay. So instead of DP, you'll write market value. This is the first thing. The second thing, again, this gift relief is the part of business relief chapter. So now just think, if parents are transferring business to the next generation, just think, and on this transfer there is a big tax, so in this way people will be reluctant to transfer the business to the new generation, so the business won't come in the hands of new generation. So how will the business grow? Just think. So government has introduced this relief that if you transfer, if between the connected person, like family members, connected persons are family members, if the business is transferred, then you can claim this gift relief. So your gain will be deferred. You don't need to pay any tax now. You don't need to pay any tax now. And don't worry, guys, I'm gonna show you the conditions as well. First, let me do a little working for you. See, for example, dad has bought a business asset for $10, and now the market value is 50, but dad sold the asset to the son for 15. Okay. So whenever there is a transaction between connected person, in the gain, we use market value instead of DP. So the market value is 50 and the cost is 10. So the final gain is 40. Final gain is 40. Okay. Now my dear student, let us say both dad and son elected, they are agreed for this gift relief. So can you see how much gift element in this? How much gift element in this? The market value is 50. The market value is 50 and the consideration is 15. So there is a gift element of 35 in this. So you can claim gift relief up to the extent of gift. So yes, you can claim 35 as a gift relief. So gain immediately chargeable is 5. Gain immediately chargeable is 5. Now, the next question. The gain which you have, the relief which you have just deducted 35, is this a permanent exemption, or it's just a deferral? It is just a deferral. Now, what is the working for this deferral? The base cost for the son will be reduced. So son has got the asset with market value of 50. Son has got the asset with market value of 50. And now how much is the gift relief? It's 35. It's 35. So 50 minus 35, the base cost will be 15. The base cost will be 15. And now, my dear student, as the base cost has been reduced for son, so automatically the future gain of the son will increase, and this is what we call deferral. This is what we call deferral. Okay, right? There is a little lagging in my pen writing. Okay, I write first and it comes on the screen a little late. There is a little lagging. Okay. Okay, next thing is conditions for gift relief. There are certain conditions which must be met. There are certain conditions which must be met. First of all, if you are giving any asset, if a dad is giving any asset to son, then for any asset, that asset must be a business asset in the hand of donor. Like if the dad is giving a factory, if the dad is giving a warehouse, so yes, definitely the factory or the warehouse must be used in the business by dad. Okay. Second thing, or see, it is written or. If the dad or mom is giving shares to the son, then there are two simple cases. The first case, if the shares are of unlisted company, if the shares are of unlisted company, then in that case, my respected student, no need to check any holding. If the holding is 1%, 0.1%, it's okay. It's okay. No problem. But if the shares are given of a quoted company, if the shares are given of a quoted company, then you must open your eyes and see the holding percentage. The holding percentage must be 5% minimum if you want to claim gift relief. Otherwise, gift relief, you can't claim gift relief. Otherwise, you cannot claim gift relief if the holding is less than 5%. Okay, so be careful with the holding percent if it is a if it is a quoted listed company. And I still remember when I teach, I teach when I teach in class, I give this dodge as well, that I give you a question, I solve these questions in the class with quoted company, but holding is less than 5%, like 2 or 1%. So in the end, the teacher says that you cannot claim gift relief at all. Okay. And one more thing, for gift relief, joint election is must. Joint election is must. What do you mean by joint election? For example, mom is giving gift to shares to son. So both mom and son has to has to sign on a paper that we both are agree with this gift relief thing. Okay, why they want joint election? Because the gain is to be transferred to the next generation. Okay, now there is one small thing, how to compute market value of quoted shares. Market value of quoted shares, as you know, in the gift relief chapter, you know, you have to use DP. You have to use DP as a market value. Market value is used as a DP. So sometimes you need to calculate this market value. You need to calculate this market value. So as a student, you may ask, sir, for quoted shares, market value is not a problem. Like, for example, you have gifted shares to your son on Monday. So just open the screen of stock exchange. Open the screen of stock exchange and see the market value. So my respected student, on Monday, even the market value fluctuates 1,000 times. So which market value you will take? It's a problem. So that's why they have given you the rules. That's why they have given you the rules. On each and every day in the stock exchange, you get the lowest and highest quoted price. On each and every day, you get lowest and highest quoted price. You get lowest and highest quoted price. So the lowest quoted price is 10 and highest quoted price is 12. Lowest is 10 and highest is 12. So just take the mid. The mid quoted price will be your market value of quoted shares. The mid quoted price will be the market value of quoted shares, right? Okay. Now, the next topic is PPR. The next topic is PPR. The next topic is PPR. Principal Private Residence Relief. Principal Private Residence Relief. Just read it for 1 minute. Just 1 minute. Okay, read it. Okay. PPR is Principal Private Residence Relief. You know that we all are human being, and this is the need of human being to live in one house. At least one house is needed. So what government says, if you buy one house, and if you stay in that house for residential purpose, then whenever you sell that house, whenever you sell that house, you don't need to pay any tax. It's exempt. You don't need to pay any tax. It is exempt. It is exempt. Okay, right? Okay. But again, you have to buy with the intention of staying in the home, and you have to stay. Two things. Now, this is called deemed period of occupation. What is deemed period of occupation? The deemed period of occupation means although you are physically absent from the house, you are not in the house, but government tax department will assume, okay, you are living in the house, don't worry, right? So these are the deemed period of occupation. These are the love from tax department. This is basically a relief from tax department. See, point number A, 36 months without any reason. You can go out from your house for 36 months without any reason. You can go on vacations, marriage, anywhere. Tax commissioner won't ask anything. Second thing, any period of employment working abroad. If you are going for abroad for working for job, yes, you can go for unlimited time, no problem at all. Then if you're 48 months of working elsewhere in UK, if you want to work elsewhere in UK, like if you normally you live in London, but now you are going to Scotland, now you are going to Edinburgh, now you are going to Wales for doing job or business, both. See, employed plus self-employed, then again 48 months relief you can get. So these are the three deemed period of occupation which you can claim. But yes, there is a very special condition. For this deemed period relief, there must be a sandwich. There must be a sandwich. Sandwich is very important. Sandwich means before leaving house, you must stay before and after of that absent period physically in your house. Physically in your house. So if you want to claim the relief of deemed period of occupation, sandwich is very important. Sandwich is very important. Okay. Then finally, last 9 months are always exempt. Last 9 months are always exempt. And for last 9 months, no sandwich is required. Even if you are living, not living, you are present in the house, you are going to anywhere, Europe, every last 9 months are always exempt. But yes, there is only one condition. If you want to claim this relief of last 9 months, only once in your life, you have to stay at least 1 month in your house, at least 1 month in your house, once in the life in that house. Okay. Then last 9 months are always exempt. One more thing, that is letting relief. One more additional relief with this chapter, with this PPR chapter, that is letting relief. Letting relief is there are two types of absence. One is deemed absence period and the second is chargeable absence period. What is deemed absence period? Deemed absence period means you are out of your house, but still the government is considering you as if you are in the house, like ABC or last 9 months, ABC relief of deemed period or last 9 months, it's deemed period of absence. And one is what we call chargeable absence period, the period of absence which is chargeable. You are leaving and the government is punishing you for that. Okay. So letting relief is only available now if there is a chargeable absence period and you have given your house on rent. Okay. But since last few years, there is a change in the letting relief, that now letting relief is only available. Read the lines. Now letting relief, see the screen, is only available if letting is done during chargeable absence period, plus owner is also living in the same property. Like, see the sketch. This is the complete property and owner is living is on the 60% area and the remaining 40% area is rented. Like on the ground floor, owner is living and the first floor is rented. First floor is rented. In that case, you can claim letting relief. In that case, you can claim letting relief. Okay. So be careful with this letting relief. It comes sometime in the exam. With PPR. Don't worry. I'm going to show you the working of this letting relief as well. How to calculate letting relief. See, in the PPR chapter, normally you make these three columns. When you read the question, you make these three columns: total months, exempt months, and chargeable months. Total months, exempt months, and chargeable months. How to calculate PPR? PPR is basically simple formula: gain multiply by the exempt months divided by total months. Gain multiply by the exempt months divided by total months. Gain multiply by exempt months divided by total months. Okay. Now, How letting relief is calculated? How letting relief is calculated? Letting relief is basically lowest of three things. Letting relief is lowest of three things. Number one, write the PPR itself, copy paste. Then gain attributable to chargeable absence period. Chargeable absence period. See, your chargeable absence period is like 30 months and your total months are 100 months. So you need to calculate gain for these chargeable absence letting period. Chargeable absence letting period, right? Okay. And the third point is maximum 40,000. Maximum is 40,000. So compute these three numbers, whatever is the lowest number, you have to calculate PPR. You have to calculate that will be your letting relief. Okay. So students, finally, I'm going to show you the full format of PPR, full format of PPR question. How you approach the PPR question. First of all, you write the disposal proceed. Less cost. In the first instance, you calculate gain before PPR. Now in the PPR question, students, first of all, you calculate PPR. What is the formula for PPR? Gain multiply by exempt months divided by total months, you get the PPR. Okay. Now, once you deduct the PPR, you come to gain after PPR. At gain after PPR, whenever you come to gain after PPR, just always stop and think. Is there any letting relief in the question? The answer is listen. Just there is one technique. Did you let your house in the chargeable absence period? Plus you are also living in that house at the same time? If yes, then yes, you need to calculate letting relief. And how to calculate letting relief? See the screen. Letting relief is the lowest of these three things. Then you will deduct letting relief, and finally you will get final gain or chargeable gain. Final gain or chargeable gain. Okay. Right. This is how you approach it. This is how you approach the complete question of PPR. Yes. Somebody is asking, do we have to calculate letting relief on the percentage of house? Yes, that percentage is applied in the columns, the three columns. You remember, total months, chargeable months, exempt months. That percentage is automatically applied there. In that step. Now, one of my favorite area. I love capital losses. I personally love capital losses. That's why when I teach chargeable gains in the very first class, we discuss this capital losses. Listen, first thing is same period capital loss can only set off capital gains. Capital loss, even in companies as well, capital loss can only cancel capital gains. Capital loss cannot set off any other income. Be careful, be very careful, even if it is individuals or companies. Very clear, okay. Now, same period capital loss will cancel same period capital gains without any permission. Even sometime you lose your annual exemption, there is no planning at all. Same period capital loss will hit same period capital gain without your permission. Okay. Now, if there is some unused capital loss, if you set off capital gains and capital loss and still the final answer is capital loss, so the unused capital loss will be carried forward for future. Now, that future carried forward loss for the next period, it will be a brought forward capital loss. There is a planning for that brought forward capital loss. Listen my words. Brought forward capital loss will be used in such a way that you never waste your annual exemption. Yes, so now you have, with brought forward capital loss, you should plan that you don't waste your annual exemption at all. Now this area is a new area. This area is a new area. This area is a new area. Let me move the screen. This area is a new area which is called payment on account of RPG. If you use your brain, with RPG, government is little strict. With RPG, government is little strict. The tax rate of CGT is higher in RPG. And now one more thing, with RPG, they don't give you time till 31st January of next year. No, 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 no. They say pay immediately. Pay immediately within 60 days. Pay immediately within 60 days. Pay immediately within 60 days. Okay. So let me just recall you that working. Definitely we are doing revision. We are doing revision. Let me just recall you. Let me just recall you. See the slides. First read the slides. Be confident. Be confident, you will understand it. Read these slides. Only this payment on account is with RPG. Whenever you have a RPG in your fiscal year, then you have to pay immediately tax within 60 days. For payment on account, you need to account for capital losses brought forward and capital losses till the date of gain. This is the first law. This RPG will also be included in the year-end assessment, self-assessment of CGT calculation. Don't worry, don't worry. Just read it. Just read it. Just read it. See, there is a practical question in front of your screen. Guys, I've moved the screen. There is a practical question. There is a practical question, guys. See, with the name of Zake. So you have few events. See, 10th April 23, there is a capital loss. There is a capital loss on 10th of April 23. Then you have a normal gain. Then you have a normal gain because shares is NG gains. Then on 31st August 23, you have RPG. You have RPG. 31st August 2023, you have RPG. Now, see, I have made a rectangle. Students, I have made a rectangle till the date of RPG. So for the calculation of payment on account, the first payment, till the date of RPG, all losses you need to account for. Till the date of RPG, you need to account for all losses and brought forward losses. So there is a loss of 4600. There is a loss of 4600 which you need to account for. Okay. See, students, this is the calculation of RPG. This is the calculation of RPG. There is a little lag in my screen, little lag. I move my screen first, it comes to you a little late because of the internet connection. Students, can you see? See, you have RPG of 82,000. Until August 23, there is only one capital loss of 4,600. So that capital loss you need to account for. And yes, annual exemption for RPG, annual exemption is always used in the first priority. So you will deduct annual exemption, it is 71,400. And in this question, they openly told you that this guy is HRTP. HRTP means higher rate taxpayer, and the higher rate for RPG is 28%. So you can see there is a number of 1,992. This is your payment on account. This is your payment on account, and you need to pay. Please be careful, be active. You need to pay within 60 days. Within 60 days, okay? And my best advice, honest advice for my students, once you calculate this POA, now forget the calculation. Forget this calculation. Forget this calculation. Forget this calculation. Only just keep this 1,992 in your mind that you have paid an advance tax of 1,992. Just delete. Just my word. See, just delete this calculation from your mind. Otherwise, it will confuse you. Otherwise, it will disturb you. Once you calculate the POA, just cross, just delete this calculation from your mind. There is a hack, there is an issue. Just keep this POA in your mind that you have paid advance tax. Just you have paid advance tax like pay. Like pay as you earn, you have paid one advance tax. That's it. All other calculation, you just forget it. Now, what to do at the year end? At the year end, what you do? Let me move the screen. At the year end, my dear students, you have to solve this question again right from zero. At the year end, see, year end self-assessment, solve this question right from the scratch with all gains and all capital losses. All gains and all capital losses. See, so if you see the big picture of the question, there is one RPG and there is one NG in the question. So you will make separate columns. And yes, all the capital losses during the year are set off from RPG because the RPG has got the highest tax rate. RPG has got the highest tax rate. Okay. And obviously annual exemption from RPG as well. So finally, you will calculate tax on these two. Finally, you will calculate tax on these two. And now see your total CGT is 21712. Your total CGT is 21712. 21712. Listen, once you calculate total CGT, now you will close your eyes and you will think that you will say tax department, yes, I agree, my total tax is 21712. My total CGT is 21712, but sir, I have paid one advance payment through POA of 19992. 19992. So the tax department will say, okay, you can deduct that 19992 and the remaining tax, the remaining tax is 1720. 1720, right? This is just a, I would say, if somebody is asking a question that you have deducted annual exemption before and after, just forget that before calculation. That's why I crossed it. That's why I crossed it. Just think this is your total tax 21712 and you paid this tax in two pieces. These are the two pieces. That's it. Your total tax was 21712 and you paid in two pieces of 19992 and 1720, nothing else. Nothing unfair with you. You paid your total tax of 21712 in two pieces. One is 19992 and second is 1720. So guys, it's my recommendation to you that this topic, keep a special revision just day before the exam for this topic because this is a little non-routine topic. I think there are few questions in the exam kit up with this. So you need to recall this whole mechanism or you need to walk through my slides just a day before the exam for this topic, for this payment on account topic. Be careful. Remember this. Okay. See, there are something which is called truth. Better you accept the truth. In tax paper, there are things which you need to learn. There are things which you need to memorize. So your brain must be relaxed. Your brain must be confident. Then only you can do it. But yes, the pass rate is excellent. I have showed you the results, the numbers. You can see the global pass rate. Everything is good. In terms of clearing paper, F6 is the best paper. But in terms of study, it sometimes gives you tough time. It sometimes you feel, you say, what is this? There are a lot of things to learn. Even some position holders, I'm not talking about ordinary guys. Some position holders, they sometimes message me, sir, there are too many things to, they just mix it up. So I say this is routine with the tax. This is routine with the tax. Even, I have businesses, different businesses, and I have some international transactions as well. So sometime when I sit with my tax man, and definitely I have also a tax man, and I ask questions from him. So sometimes he also does mistake that if your money is coming from here, so he sometimes mixed it up because of lot of rules. So this is the reality of this paper. So better accept it. Better accept it. You will be happy. Now, the next thing is chattels. There is a topic called chattels. Chattels means tangible movable property. Tangible movable property. For example, this phone, see, it is tangible, it can be touched. Movable, see, it's movable property. So your cell phone, your pen, your glass, your your dinner sets, your paintings, right? The sword, your watch, all these things, your bracelet, right? They all are called chattels. They all are chattels. So chattels are tangible movable property. Now the tax department has divided chattels into two groups. The first is called wasting chattels. Wasting chattels are normally the chattels with expected life of less than 50 years. So normally we see many chattels around us, they are wasting chattels. And the like cell phone is the best example of wasting chattels, right? So the normal rule is they are exempt. Wasting chattels are exempt. They are only taxable. See the screen. They are only taxable if they are used in the business and you claim capital allowances on it. If they are used in the business and you claim capital allowance on it. Otherwise, it is exempt. Basic rule. Now the second is non-wasting chattels. Non-wasting chattels, by definition, you can think the chattels with expected life of more than the chattels with expected life of more than 50 years, more than 50 years. Okay. So normally it comes with antique items like jewelry, like grandmother jewelry. Grandmother bought it like 60 years back, or grand to grandmother, right? Okay. And you have seen museums. In the museums you see different swords, they are like 1000-year-old sword or 600 years. So these all are non-wasting chattels. Okay. Antique items. For antique items there are four special cases. For antique item there are four special cases. See, this is the real topic. This is the real topic which I'm going to tell you. See, the case number one, if cost is less than 6,000, like you bought an antique chattel, like you bought a non-wasting chattel for 6,000, less than 6,000, and you sold it for less than 6,000, bought it for less than 6,000, sold it for less than 6,000. In that case, there is no gain, no loss. Just skip the calculation. Just skip the calculation. The second case, case two, if the cost is greater than 6,000 and DP is also greater than 6, both are greater than 6,000, then just do normal CGT calculation like you used to do. Do normal CGT calculation like you used to do. Okay. Now case number three. Case number three. If cost less than 6,000 and DP, this is a very important different case. If cost is less than 6,000 and DP is greater than 6,000, for example, you bought it for 5,000 and you sold it for 8. So cost is less than 6, DP is greater than 6. Then you have to do these two workings. First of all, do the normal working, which I have taught you for gains. And the second working, see, this is the second special working. Second working is, wait. Second working is gross. Second working is gross DP minus 6,000 into 5 upon 3. Gross DP minus 6,000 into 5 upon 3. Whatever will be the lower of, whatever is the lower answer, just pay tax on that answer. Okay. So for case 3, there is a relief. The gain will be lower off. The gain will be lower off. So it's a good news. It's a good news. Now what is case 4? Case 4 belongs to loss. Case 4 belongs to loss. Case 4 is a loss making thing. See, if cost is greater than 6,000, if cost is greater than 6,000 and DP is less than 6,000, definitely loss case. Like cost is 10, DP is 4, so it's a loss case. Then any capital loss will be computed using deemed DP of 6,000. You are not required to use the actual DP now, use the deemed DP. Okay. So in this way, your loss will be reduced. In simple words, I say one thing, that in case 3, they reduce your gain, and in case 4, they reduce your loss. Tit for tat. They just got back the relief. Okay. Now the important points. there are some important point which is very important. In the history of your past papers, in the history of your exam kit, history says examiner never used the word chattels straightforward. Examiner never uses the word chattels straightforward in the exam. You have to recognize yourself. They will tell you the story that there is a painting or there is a jewelry or there is a table like this thing. Okay, so you need to use your brain. And the second thing is, normally whenever if they don't use the open word wasting chattels, normally it is assumed that it's a non-wasting chattels, and then you apply these 4 cases on chattels. Then you apply non-wasting chattels on the case of non-wasting chattels on this chattels thing. Okay. The next topic is again favorite topic, transfer of chargeable asset. Transfer of chargeable asset between married couples, students. Transfer of chargeable asset between married couples and civil partners. Okay. So if husband is transferring one asset to wife, then it's a no, it's straight away it's a no gain no loss transaction. Straight away it's a no gain no loss transaction. And no gain no loss means gain or loss zero. Gain or loss zero. So gain or loss will be zero when it is transferred cost to cost. When it is transferred cost to cost. For example, see this. Please check it out. For example, Mr. A, his husband bought an asset for 10. Husband bought an asset for 10. Now husband transferred this asset to wife for free or whatever the price. But this transaction between husband and wife is a no gain, no loss. This transaction between husband and wife is a no gain, no loss. So how it becomes no gain, no loss? When it is transferred cost to cost. So now the cost of husband will becomes the cost for wife. The cost for husband will become the cost for wife. Okay. Now later on, Mrs. A will be selling this asset to the third party for 80. So finally, in the books of Mrs. A, there will be a gain of 70. There will be a gain of 70. Now, those students which are active, those students which are good thinkers, they can think this is a very good relief. Through this relief, husband can transfer the entire transaction to wife. Entire gain has been shifted to wife. See, and what is the planning area? For example, husband is a higher rate taxpayer and wife is a basic rate taxpayer. So now if husband will shift this gain to wife, so in this way, family will enjoy the tax benefit. Family will have to pay low tax. Okay. Now this is the issue of death. This is the issue of death. This is the issue of death. Okay. Transfer of chargeable asset at the time of death is exempt from CGT. This is a very good, very famous good news. And the market value of asset at the time of death becomes the base cost of asset for son. Wait, now, for example, dad bought an asset in his life for 10. See the screen. Dad bought an asset in his life for $10. Now, till the date of death, the market value increased to 70, from 10 to 70. But the dad was very strict. He didn't give this asset to son in his life. So now what will happen? From this 10 to 70, this 60 gain is exempt through for the whole life. Now there is no need to pay tax on it. Now, when at the time of death, when this asset will be transferred to son, then this market value at the date of death will be the base cost of asset for son, right? And later on, if son sell it for 90, so son has to pay tax on only this 20 gain, only this 20 gain. So the planning point here is that this, whenever somebody wants to transfer a chargeable asset for CGT purpose, I'm not talking about inheritance tax now. I'm not discussing IHT now. I'm just discussing CGT here. For CGT purpose, it's better not to transfer asset in the life. It's better you transfer your asset after death. So there will be exemption. Okay. Now, this is a story which I call it very interesting. For me, this story, see, the name of this story is interesting. In my normal class, I use the word in Urdu, mazedar. It's mazedar. Okay. So listen, see the story. It starts with this grandfather. This is grandfather. Okay. So first of all, grandfather bought the asset for 10 and grandfather transferred this asset to his wife, that is grandma. Okay. So the first transfer is between husband wife. See, the first transfer from grandfather to grandmother is husband wife transfer, and husband wife means no gain no loss. Husband wife means no gain no loss transfer. So the cost for grandfather will become the cost for grandmother, that is 10 pounds. Okay. So first of all, asset is shifted from grandfather to grandmother. Okay. Now, grandmother kept this asset with herself. She didn't give it to anybody. Now, after a few years, grandmother died. Grandmother died, and at the time of his death, the market value of this asset is 80. The market value of this asset is 80. Now, after his death, the asset is transferred to grandson. Now, the good news is that the difference between 10 and 80, 10 and 80, there is no tax. There is no tax at the time of death. Now, the market value of this asset at the time of death will become base cost for son. So the base cost for son is 80 pound. Base cost of this asset for son is 80 pound. Okay, so the asset has reached the grandson. Finally, grandson also transferred this asset to his wife. Okay. And again, this is a husband wife transfer, so no gain, no loss. Husband wife transfer, so no gain, no loss transfer. Husband wife transfer means no gain, no loss transfer. So the cost for grandson will become the cost for the wife of the grandson, that is 80 pound. That is 80 pounds. That is 80 pounds. Okay. So finally, this asset reached to the wife of grandson with a cost of 80 pounds. Now the question says, finally, the wife of grandson sold this asset to third party for like 200 pounds. Sold this asset to third party for like 200 pounds. So what will be the final gain for the wife? It will be 200 pounds less the cost, which is 80 pounds. So final gain for the wife is 120 pounds. Final gain for the wife of grandson is 120 pounds. My dear student, did you understand this example? Did you understand? It came once in the past paper. Please write in the chat box if you understand, if you understood it. Hey, now there is a topic, shares and securities individuals. There is a topic which is called shares and securities, dear students, individual shares and securities. Individual shares and securities. Okay. So whenever any individual sell the shares or gift the shares, like transfer to son or daughter or anybody, definitely gain is computed. So whenever you are going to calculate gain or loss for individuals of shares, you need to write DP less cost, DP less cost. So for cost, there is a matching order rules. For cost, there is some matching order rules. For cost, there is some matching order rules. Okay. And what are those matching order rules? First of all, same day purchase. If you have bought on the same day, first match that cost. Second is following next upcoming 30 days purchases. And the third is shares from pool, average cost from pool, shares from average cost from shares pool. And definitely, I hope you know that this pool is made just one day before the disposal date. The disposal, just one day before the disposal date, you bring all the shares in pool. You bring all the shares in pool. So whenever you see that somebody is selling, individual is selling or gifting shares, so for the calculation of gain or loss, capital gain or loss, in cost, you have to use this matching order rule, same day purchase, following 30 days, and shares from pool, just for your recall person. But if a company is selling shares, the matching order rules for company is different. Matching order rules for company is different. Same day purchase, last 9-day purchase, and then shares from pool, which are bought before 9 days. Okay. So these are the 3 steps for shares and securities companies. Shares and securities companies are different. Okay. Now, how to incorporate right and bonus issue. How to incorporate right and bonus issue in your pool. Right and bonus issue. Hope you remember what is right issue. Right issue is not a free issue. Like right issue is giving to existing shareholder for cost. For cost that you have to pay. If you are a shareholder and a company is offering a right share, so you need to pay it. So whenever there is in the question they give you a right shares, so you need to update both columns, shares as well as this column as well, shares as well as this column, cost as well. In case of right issue, you need to update both columns, number of shares as well as the cost column. But in case of bonus issue is a free issue, my dear student. You get free shares, so you just have to update the number of shares column. You don't need to write anything. You don't need to write anything in the cost column. You don't need to write anything in the cost column at all. This is how we work for right and bonus shares. Okay, because bonus shares are free shares. Okay, I hope you remember it. Now there is one area which we call it paper to paper takeover. There is one area which we call paper to paper takeover. Let me explain you this question which is on the screen. Not difficult. I will give you a good revision if you just concentrate it. Listen, Mr. A originally, see, first look at Mr. A. Mr. A originally purchased 10,000 ordinary shares of X company. 10,000 ordinary shares of X company few years back, like 2-3 years back. 2-3 years back, Mr. A purchased 10,000 shares, ordinary shares of X company for 40,000. So Mr. A became the shareholder of X company. Simple. Mr. A has ordinary shares of X company. Now, after 2, 3, 4 years, now Y company, see, there is one more company. Y company's management decided to take over X company. So whenever one company wants to acquire another company, they need ordinary shares. So Y company gave ad in the newspaper that whoever has the ordinary shares of X company, please come and meet us. So yes, Mr. A is the right guy. He has the ordinary shares of X company. So Mr. A went to Y company. So Y company offered this deal. See the deal. There is a deal in the mid of my screen. Y company said to Mr. A that if you give your one ordinary share, if you give your one ordinary share of X company, in return, we'll give you these three shares. In return, we'll give you two ordinary shares of Y company and one preference shares of Y company. Two ordinary shares and one preference shares. Mr. A said, done, done, I'm ready. So this deal is basically a share exchange. This deal is basically a share exchange for Mr. A. Now, can you elaborate this share exchange? Can you elaborate this share exchange? Yes. How? See, total shares are 10,000. So the deal is 1 for 2 ordinary, 1 for 2, double the ordinary, double the ordinary. So Mr. A has just given 10,000 shares. So he will be getting 20,000 ordinary shares. Okay. And yes, 1 for 1. Preference share deal is 1 for 1. So 10,000 preference shares, okay, of Y company, okay. So in simple terms, Mr. A given up his 10,000 ordinary shares of X company. In return, Mr. A got 20,000 ordinary shares of Y company and 10,000 preference shares of Y company. Now Mr. A took out his cell phone, and he called the tax department. Do I need to pay any tax? Do I need to pay any tax? The tax department said, did you get any cash? He said, no, 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 I didn't get any cash. I just gave away my shares, and in return, I got new shares. So the tax department said politely that if you don't get any cash, we don't charge any tax. So no tax. But yes, the tax department said one thing, that previously you had only one class of shares, that was ordinary. But now you gave away your ordinary shares and you have two different class of shares, ordinary and preference, and you incurred this cost only. Which is 40,000. So now you need to split this cost between these two types of shares. You need to apportion this cost between these two type of shares. And for apportionment, there is one thing which we call base. We need to use the base, and the base are market prices of these shares at the date of takeover. Market value of these shares at the date of takeover. So let's calculate the market value of these shares. See the screen. I have written here market value of 20,000 ordinary shares. How much is the market value of one ordinary share of Y? It's £4. So 20,000 multiplied by 4. 20,000 multiplied by 4 will give you 80,000 pounds. And market value of one preference shares. Market value of one preference shares is £2. So 10,000 multiplied by £2 is 20,000 pounds. Okay. So this will make 80 plus 20 is 100,000 pounds. 80,000 plus 20,000 is 100,000 pounds are the total market value. Now just use this market value as a base. So see the screen. This 100,000 is 100%. Okay. And can you tell me 80,000 is how much of 100,000? 80,000 is how much percentage of 100,000? 80% and 20%. So these are the percentages. 80% and 20%, 80% and 20%. These are the percentages, my students. So now you can split the original cost of 40,000 between 80 and 20. So 40,000 multiplied by 80% is 32,000 pounds. And 40,000 multiplied by 20% is 8,000 pounds. So you can write base cost of 20,000 ordinary shares of Y company is equal to 32,000 pounds. And base cost of 10,000 preference shares of Y company is equal to £8,000. Okay. So finally, you have split the base cost. Finally, you have split the base cost of these two. Finally, you have split the base cost of these two. Okay. Right. You got it. As a student, you may ask one question. Sir, why did you split the base cost between these two? Very simple answer. There is a possibility or there is a reality that definitely these two are separate class of shares. So separate pools you have to make. Separate pools you have to make. So for separate pool, you need separate cost. First answer. Second answer. There is a possibility later on you sell these shares separately on different occasions. So if you sell these shares separately on different occasions, so definitely you need separate cost for these two shares. So that's why we split the cost. That's why we split the cost. Yes, can we gift preference shares to family member? Yes, we can gift anything. One thing I'm just giving you a little. See, there is a similar topic in your exam. You have done normal course. This is just you are doing revision. You have already done the normal course. So there is a topic paper to paper takeover relief, and there is one topic reorganization. There is one more topic which we called reorganization. Normally, the workings for paper to paper takeover and reorganization is pretty similar, right? But there is one difference. In reorganization, you gave away your old shares of the same company and the same company shares you get. Same company, new shares you get. But in paper to paper takeover, the companies are different. Okay. In reorganization, there is only one company. Same company shares are exchanged. Same company. You gave away your old shares, you get new shares. But in paper to paper takeover, the companies are different. Okay. Right. Now, my dear students, I have very good MCQs of Study Hub, ACCA Study Hub MCQs I have. But the problem is that there is some lagging in my screen. So, and now for the questions, I have to use the pen. So what I'm doing is I'm going to end the class now. And I'm going to send the remaining area. I'll record it. So, because for recording, I don't need any internet thing. So I'll connect this class with these MCQs with our normal class and will send you. Okay, right? Because if I write here, it will be a big lag. There is a big time difference between my writing and the thing is coming on the screen. Okay, so I would request you, don't waste your time. But at the same time, please, at the same time, be confident. Stay away from negative people. That is the key. I have taken interviews of many position holders. They think positive. They make folder. They write. Even in their bedrooms, they write. They make the like sticky notes. Okay, right? And stay on the group. I'll send you many things. Even I have a plan to record a class like for famous mistakes of F6. Famous mistakes in F6. If I call this in Urdu language, it means mashhur galtiyan. If I say in Urdu language, it is mashhur galtiyan. Okay. And yes, this paper requires this class, famous mistakes in F6. There are very small things which students forget. So we are making notes like similarly the differences between individuals and companies. This thing is allowed in individual, not allowed in companies. This is allowed in VAT, this is not allowed here. So if we should make a class for famous mistakes in F6. Okay, so guys, I'm going to solve these MCQs and will send you the complete class. So now we are moving towards MCQs of CGT, chargeable gain tax. So you can see the question number 1. Peter purchased a holiday home in July 2014. The holiday home cost 95,000. Yes, original cost is always allowed for CGT purpose. Original cost is always allowed for CGT purpose. Don't forget. Now, he paid legal fees of 2600 relating to purchase. Yes, legal fees to buy or sell. Legal fees to buy or sell the property is also allowed. During 2019, he spent 6700 on an extension to the kitchen. Yes, extension cost. Extension is basically improvement. Improvement is also allowed for CGT purpose. I am talking about CGT purpose. Now, and in 2022, he spent 3300 on roof repairs. Roof repairs. Repairs is the revenue expenditure, and revenue expenditure is not allowed, never allowed at all for CGT purpose. Okay, because CGT is the world of capital receipt. CGT is the world of capital receipt. Peter anticipates selling the house in the next few months. What is the total amount of allowable expenditure? That means allowable cost. Allowable expenditure means allowable cost, okay, on the disposal of holiday. So this is allowed 95,000, this 2600, and this 6700. So if we add these three, so it will be 104,300. Okay, so answer is C. Answer is C. Answer is C. Okay, right? Now the next question is question number 2. For the tax year 23-24, Arthur's taxable income means after deducting personal allowance. Already personal allowance has been deducted. Be careful. During the during the year he sold an antique chair which gave rise to a chargeable gain of 28,300, right? So antique chair, just use your brain. Antique chair is not a property, it's not a residential property, so this gain is not RPG. Also this is not QG. Definitely qualifying gain, there are different conditions. So this is normal gain, this is NG. Okay, now let's start. What is the Arthur's capital gain tax liability? Now the first thing is your first band is 37,700. Use your common sense. First band is 37,700, and this is your taxable income. Your taxable income will consume your non-saving interest dividend will consume your first band. So 31985, it will consume this amount of band. So 37,700 minus 31985 will give you 5715. 5715. This is the remaining band, remaining capacity left. This is remaining capacity left. Now my dear student, let's start with CGT. So your normal gain, your NG, your normal gain is 28,300. Each and every individual gets annual exemption of 6,000, gets annual exemption of 6,000 every year, right? So it will be 22,300. This is your taxable gain. Now taxable gain is the gain on which you apply tax rate, directly tax rate. Okay, now let's calculate the tax. So you will pick this taxable gain and you'll knock on this band, so yes, the capacity of first band is only 5715. So yes, we'll use 5715 first, and the rate for the first band for normal gain is 10%. Remember, 10 and 20, 10 and 20. And 22,300 minus 5715, how much is left? 16,585. So into second band rate for normal gain is 20%. So this will be 571.5, and three triple eight. This is the answer. B is the answer. 3,888. This is the answer, right? Okay, I hope you got it, you understood it. Okay, now question number 3. Be active, students. In March 2010, Morgan purchased the freehold of an office building for 641,000. This is the original cost. Morgan sold the building in March 2024 for 1130,100. Okay, this is the DP and this is the cost. He made no other disposal of chargeable asset in 23-24, obviously, and his taxable income is 52,000. Now just use your brain. When your taxable income which is after deducting personal allowance is 52,000, so your first band, your 37,700 band is already consumed. So this time your gain will directly go in the second band. Okay, so let's calculate the gain. The gain will be DP is 111,30,100, cost is 641,000. So your gain is 11,30,100 minus 489,100. Okay, now each and every individual gets 6,000 annual exemption, 6,000 annual exemption because there are no other disposal. So minus 6,000, 483,100. This is your taxable gain, and now the complete gain will go in the second band as the first band has already been consumed. Now use your brain. There are three types of gain. RPG, this is not RPG because it is office building, so not a residential property, and you cannot claim qualifying gain on this, so definitely this is NG. Definitely this is NG. This is normal gain. This is normal gain. Okay, so and the second band tax rate for normal gains always 20%, so it's going to be 96620. It's going to be okay. So the answer will be 96620. Answer will be 96620, right? This is the answer. Now the next question, question number 4. For the tax year 23-24, Knox taxable income is 35,000. During the year, he sold a residential property which was not his private residence. Now wait. Residential property is enough. Although you are not living, it's okay, but it's a residential property, so the gain will be RPG. Gain will be RPG. Okay, so that give rise to a chargeable gain of 48,400. So this is RPG. RPG 48,400. Each and every individual gets annual exemption of 6,000 every year. So 48,400 minus 6,000, it's going to be 42,400, which is your taxable gain. Now very simple, very simple. Your taxable income is 35,000, and you know the capacity of first band is 37,700. Capacity of first band is 37,700. Capacity of first band is 37,700, and you know this taxable income will consume your first band by this. So you have 2,700 capacity left, 2,700 capacity left. Okay, now when you come to this 42,400 gain, the first, listen, the first 2,700 will be taxed at the rate 18%, and now 42,400 less 2,700, 39,700. The remaining 39,700 will go in the second band with the rate of 28%. Now can you add these two? This is going to be 111,116, yes, and 2,700 into 18%, 486. Double 11602, 11602, 11602. right? So this is going to be your capital gain tax liability. Okay. Question number 5 now. For the tax year 23-24, Samantha has chargeable gains of 2,700 and a capital loss of 10,000. Now, same year gains and same year loss. Same year gains, same year loss. They will cancel out without permission. So this is going to be 27,800 less 10,000. So after deducting this loss, the gain is 17,800. Now, you can do planning with the brought forward loss. We all know with unused brought forward loss, you can do planning, and unused brought forward loss can only be used to the extent that you do not waste your annual exemption. So use your brain, use your common sense. Out of this 25,700, you will use this much amount, that final answer will become 6,000. Final answer will become 6,000. So can you calculate it? Yes. 17,800 minus 6,000, 11,800. Yes. So out of this 25,700, how much you will use? Brought forward loss, how much you will use? 11,800. Now out of 25,700, once you use 11,800, so how much is left? The remaining 13,900 to be carried forward, for 24-25 fiscal year. Okay, so they are asking the amount of unused capital loss can Samantha carry forward. Yes, it's going to be 13,900. A is the answer. A is the answer. A is the answer. Next thing is question number 6. See, this is the copyright case. Copyright case. Hope you remember the wasting assets. Wasting assets, the intangible asset thing. Wasting asset, the intangible asset. Listen very carefully. For this thing only, normally how we calculate gain? Normally in chargeable gain tax, how we calculate gain? DP less cost. But for such copyrights and wasting assets like intangible assets, we calculate gain using DP less NBV, disposal proceed less historical depreciated cost, or you call it NBV. Very simple. So now we need to calculate NBV. Listen, Jessica sold a copyright. First of all, they are selling copyright for 28,800. So this is DP. DP is 28,800. Now less you need to deduct NBV, or you sometimes call it depreciated historical cost. Okay, the copyright had been purchased on 1st April 18. See the date 18, and now it's 24. This is 18, this is 18, and this is 24. So 6 years have been passed. 6 years have been passed. So you need to calculate depreciation of 6 years. Now the original cost is 21,000. Original cost is 21,000 less accumulated depreciation. Less accumulated depreciation. Wait, how much will be the depreciation? 21,000 divided by 15. See, 15 years is the life. So you will be doing 21,000 divided by 15. This is 1,400 per annum multiplied by 6 years. So your accumulated depreciation is 8,400. So what's your NBV? What's your NBV? It's 12,600. Yes. So now you can deduct 12,600 from here. Finally, you will get again chargeable gain. They are asking just chargeable gain, not taxable gain. They are asking chargeable gain, not taxable gain. Okay, so your answer is 16,200. C is the answer. C is the answer. C is your answer, right? Okay. Okay. So next question is this Chattels land and building. Okay. On 21st March 2024, Jason sold 6 hectares of land for 69,000. Okay. This is basically a part disposal area. Part disposal. Hope you remember part disposal. He had originally purchased 9 hectares. Okay, for 50,000. This is the original cost. On 31st January 2023, Jason spent 6,000 leveling the 9 hectares. See, this cost is incurred on complete land, not just one portion. This is very important. This cost is incurred on complete land, right? So this improvement is done for the complete land. So this is the part of complete cost. Okay. The market value of the unsold 3 hectares is 27,600. Okay. Okay. So let me make a sketch for you. The total cost for 9 hectares is 50,000 plus the leveling cost, which is, we call it improvement. Okay, the improvement is 6,000, and all this improvement is also incurred on the complete property, 9 hectares, complete 9 hectares. Okay, now out of this 9 hectare we sold 6 hectares. This is sold, this area is sold, and this is remaining part. Now hope you remember it. So the dp is 69,000 for this portion, and they are giving you market value of the remainder, hope you remember this area, is 27,600. Market value of the remainder is 27,600. Market value of the remainder is 27,600. Okay, so now what's your total cost in this question? 56,000. Your total cost is 56,000. This cost will going to be apportioned between these two areas. This cost is going to be apportioned between these two areas. So they are asking what is the cost of 6 hectares land. 6 hectares means the land which is sold. 6 hectare means the land which is sold. Okay, so let me make you solve complete thing. So your dp is, first write the dp is 69,000 less allowable cost. This is going to be original cost, which is 56,000 into dp plus divide by dp plus market value of the remainder, which is 27,600. Okay, so this will be your allowable cost. So your allowable cost will be 40,000. Your allowable cost will be, this is 40,000. Okay, so although you can calculate the gain as well, but they are just asking you cost. Now in my lectures, many times I said this, read the requirement very carefully. This is the very super tip. Sometimes, listen my words, sometimes examiner is just asking the cost. This cost is the answer, and students calculate the gain, and the gain is also given in the one part of the MCQ. One answer is gain also. So in this way you will lose the marks. So whatever they ask you, just you need to reply that thing. Okay, so the answer is A, 40,000. Answer is A, 40,000 is your answer, right? Okay, now question number 2. In March 2018, Finlay bought a painting for 75,000. Okay, in November 2023, it was damaged by smoke in a fire. In December 2023, it was valued at 60,000 and finally received a compensation of 20,000 for the damage. Finlay spent none of the money on restoration. Now tell me, what is the final gain or loss? What is the final gain or loss on this transaction? Now this is something very, very good. Hope you remember damage and destruction area. This is damage area, right? Okay, let me make the sketch. First of all, see, you bought this complete painting. You bought this complete painting for 75,000. Okay. Now, this painting is non-wasting chattel. Non-wasting chattels. Chattel means tangible, movable property. Remember, tangible, movable property. Now, the cost is greater than 6,000 and the valuation is also greater than 6,000. So it's a normal case. Whenever your cost is greater than 6 and DP is greater than 6, then it's a normal case. Okay. So no special cases will apply. Now, they are saying it was damaged by smoke in the fire. Damage means this area is damaged. That means we bought the, listen to me, we bought the complete painting and now we lost this area. We lost this area. Use your brain. This area we lost. Okay. Now, see, this accident happened in November 2023. Now, just after November, the next month is December. In December 2023, it was valued at 60,000. It was valued at 60,000. That means in the damaged condition. In the damaged condition. So in other words, they are saying you market value of the remainder. Market value of the remainder. Let me repeat. Listen. We bought it in 2018 for 75,000 and the accident happened in November 2023, and very next month after the accident, in the damaged condition, the valuation is 60,000. That means indirectly they are telling you the market value of the remainder. Now, Finlay receive compensation from the insurance company. For this part, we receive compensation of 20,000 for the damage. Finlay spent none of the money on the restoration. Now listen, whenever you don't spend the insurance proceed on the project, that means now for sure this portion will be treated as part disposal. This receiving of insurance proceed will be treated as part disposal, and you have to calculate tax and pay tax. Okay. But yes, if you reinvest complete amount of proceeds, then you can defer this gain. Otherwise you can't. So clearly it is written, Finlay spent none of the money on restoration, none of the money. So it will be treated as part disposal. Okay. Now, very simple. This area is sold. So simple part disposal question it is. Your DP is 20,000. Okay. Less original cost of the complete project is 75. So you need to apportion it. So it will be 75,000 multiplied by DP 20 divided by 20 plus market value of the remainder is 60. I'm not writing 3 zeros. Okay. So this will be my dear students 18750. So the final gain on this area will be 1250. Okay. So this is your answer. Your 1250 is your answer. Okay. So hope you remember this area, that only in the case of damage and receiving insurance proceed you can defer the gain. Yes, only you can defer the gain once you reinvest the complete insurance proceeds. Once you reinvest the complete insurance proceed, then you can defer the gain. Okay. Now the next thing is, on 28th October 22, Leroy sold an antique vase. Right? Antique vase is here, is the non-vesting chattels. Vase is the chattel, right? So it's a non-vesting chattel because it is written antique. Now, for 1 to 100. So DP is greater than 6. But see, the cost is less than 6. Case number 3. I taught you in the same class. So when DP is greater than 6 and cost is less than 6, you need to do two working. First, do the normal working. Normal working is 1 to 1. Cost is 1700. So this is normal working. So the answer for normal working is 10,400. And you remember the alternate working is gross DP minus 6,000 into a fraction which is 5 upon 3. Remember? So this will be gross DP is 12,100 minus 6,000 times 5 upon 3. Let's see what the answer comes. So the answer is 10167 for this. Now you need to pay tax on the lower amount. So lower is 10167. Lower is 10167. This is the answer C. C is your answer 10167. 10167 is the answer. Next question, please. Anna bought a house on 1st April 1997, which she sold on 31st March 2024, realizing a gain of 150,000. It's a gain, real gain. The house was Anna's private residence. Okay, residential house. From the date of purchase until 30th September 2019, when she elected for another house for another house to be her private residence. That means till which date he used it privately, till 30th September 2019. Till 30th September 2019 he used it for private purpose, for residential purpose. Okay, so now you have done the PPR thing, principal private residence relief. So let's start. You bought the house on 1st April 97. 1st April 97, and you sold it, you sold it on which date? 31st March. 31st March 2024. Now if you know the calendar, you must know the calendar, you know how to count. So from 1st April to 31st March, 1st April 97 to 31st March 2024, exactly 27 years. Exactly total period is 27 years, and you can call it 27 years multiplied by 12. 27 years multiplied by 12 is equal to 324 months. You call it 324 months. You call it 324 months. So this is the total period. Hope you remember when you guys were doing this PPR chapter, you guys used to make 3 columns. You guys used to make 3 columns. So it's total months, exempt months, and chargeable months. Okay. So my dear student, your total months are 324 months, right? Now the change. Anna bought a house on 1st April 1997, which she sold on 31st March 2024, realizing a gain of 150,000. They are giving you ready-made gain. The house was Anna's private residence from the date of purchase until 30th September 19. Now, till 30th September 19, this is your proper APO. This period is actual period of occupation. That means she lived in this house. So when you live in some house, it's proper APO, it's proper exempt. Now, so this area is proper exempt. So looks like this area is chargeable. Looks like this area is chargeable, but because she shifted in another house and this area is no more PPR. But you know, last 9 months are always exempt. 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 So can you count this area? Can you count this area from 30th September 19 to 31st March 2024? Let me count. That this is like 3 months for 2019. 3 months for 2019, then 2020 complete, 21, 22, 23. So it will be 36 plus 6. 36 plus 6 will give you, wait. 3 months for 2019. Then you have 2020, 21, 22, 23. Yes, 48. 48 plus 6 is 54. This complete area is 54 months, but if you remove last 9 months, from this 54 months, if you remove last 9 months, so this area will be 45 months. This area will be 45 months. Now, your total time period is 324 months. Out of this 324 months, only 45 months are chargeable. Out of these 324 months, only 45 months, the middle ones, C, are chargeable. Otherwise, this area, see, let me change the color. This area you lived, and this is last my 9 months, they are always exempt. So 324 minus 45, 324 minus 45, 324 minus 45 will give you minus 45 will give you 279. Now you have calculated, dear student, you have calculated total months, exempt months and chargeable months. Total months, exempt months and chargeable months. Now can you apply the PPR relief? Yes, ready-made gain is given. Ready-made gain is given. And what is the formula for PPR? Gain multiplied by exempt months divided by total months. Gain multiplied by exempt months divided by total months. So this will be, gain is 150,000. Wait, let me do here. Gain is 150,000. Okay. Less PPR. PPR will be gain multiply by exempt months is 279 divided by 324. Wait, let me check. Okay, 279 divided by 324. This will be, wait, 150,000 into 279 divided by 324. 129,166. 129,166. Okay, so your gain after PPR, final gain will be, your final gain will be 20833. 20833. Okay, so this is your final gain. This is your final gain, students. This is your final gain. This is your final gain. This is your final gain. Okay, right? So you must know, see, this is the variety of this chapter. At one end you can get a part disposal, on the other hand you get PPR. So it's all jogging of mind. So now you need to pick true and false. Which of the following statements about a taxpayer's private residence are correct? Number 1. Any period of absence while working elsewhere in UK. Hope you remember deemed period ABC point. ABC point. This is point number C. Working elsewhere in UK is point number C. And we all know for point number C, only 48 months. Only 48 months is exempt. But what they are saying, any period, they are saying unlimited period. Unlimited period. So this is false. This is false. Any period is for point B. Any period is for point B when you go abroad. When you go abroad, this time you are working elsewhere in UK. So this is point C, only 48 months are allowed. Now, point number 2. Even if part of it is used exclusively for business purpose. Hope you remember this chapter. Listen, this is your house. And right from the day one when you bought the house till the day last day when you sold it, if you are using one portion for business purpose, if you are using one portion for business non-stop starting to end, then you know what are the rules for this portion. For this portion you don't need to pay any tax. This portion will be exempt. This portion will be exempt. Now what they are saying, even if part of it is used, read the words, exclusively for business purpose, the whole of any gain arising on its disposal is exempt. No, not the complete. See, not the complete gain is exempt. Only this portion. Only this portion is exempt. Only this business portion is exempt, not complete. So both statements are false. Both statements are false. So they are asking about correct. So neither 1 and 2. Neither one nor two. Both are incorrect. Both are incorrect. Okay. Now, my dear students, this is question number 6, and in question number 6 they are giving you the other case. See, remember we did this insurance case. We did this insurance case, and in this case, they told you Finlay spent none of the money on restoration. Finlay did not reinvest. That's why we were not able to defer the gain. But now see, in question number 6, what they are saying. On 10th of January 2024, a freehold property owned on Winfred was damaged by a fire, and the property had been purchased for 73,000. So this is your property. You bought it for 73,000. This portion is damaged. This portion is damaged. Listen very carefully. Now, how much insurance proceed we received? We received insurance proceeds of 37,200. Okay. And how much she spent 41,700. Spent 41,700. Now, very important. Just see the numbers. You receive insurance proceed of 37,200 and you spent 41,700. That means complete proceed is reinvested. Complete proceed is invested to the house. Complete proceed is invested to the house. So yes, you can defer the gain. You can defer the gain, but for that election is required. So what they are saying, Winfred has elected to disregard the part disposal. So now remove the part. There will be no part disposal gain. There will be no part disposal gain. Just you need to do the calculation for base cost. You just need to do the calculation for base cost. And I hope you remember. I hope you guys took the classes. And this is revision I have told you. So how to calculate base cost in this case? Just write the original cost, which is 73,000. Deduct the insurance proceed less proceeds, which is 37,200, and then you can add the reinvestment amount which you did 40. Add restoration amount. It's 41,000. Right. So this will be 77,500. 77,500 will be your base cost. See, what is the base cost of the restored freehold property? So only they are asking you the base cost, because definitely the gain has already been deferred. Complete gain has already been deferred. Complete gain has already been deferred. Now something about shares and securities. Some MCQs on shares and securities. Under the identification of matching rules, a disposal of shares in a quoted company can be matched to which of the following subsequent acquisition? If you have taken normal classes from me, I always start shares and securities with one statement, very famous statement. Same company and same class of shares are indistinguishable. Same company, I always write on the screen, same company and same class of shares are indistinguishable. Same company and same class of shares are indistinguishable. What do you mean by? Listen, today I bought 1,000 ordinary shares of ICAEW, and next week again I'm buying 1,000 ordinary shares of ICAEW, so they are totally same, no difference. But today I am buying 1,000 ordinary shares of ICAEW, but next week I am buying 1,000 preference shares of ICAEW, so there is a difference. They are not same. So the shares are only same if the company is same and the class of shares is same. Company is same and class of shares is same. Okay. So now where can we make the pool, and where can we calculate, where can we patch up the shares? When can we patch up the shares in one pool? So it's same class of shares and same company. Same class of shares and same company. This is the point. The same class of share. No, not similar. Similar is a different thing. Same company, ICI, right? Any class, no. So the answer is one only. Same company and same class of shares are indistinguishable, and the whole shares and securities chapter what we studied at one time whenever we calculate gain, the shares must be same company and same class, same company and same class. Then you write this thing dp, remember this thing, dp less cost, and in the cost you apply same day purchase following 30 days purchase, then shares from pool. Hope you remember the matching order rules. So for the whole for this complete working, this is the must condition, that same company and same class of shares, same company and same class of shares, don't forget this. The next thing is, Jennifer made the following transaction in the ordinary shares of Easter PLC. Jennifer made the following transactions in the ordinary shares of Easter PLC. Now, bought 2000 shares, then bought 1200 shares, then sold. This is the disposal date. Yes, this is the disposal date. Be very careful. Okay, then bought more shares and so on. Against which acquisition will the disposal of shares of 22nd August be matched? Okay, so you know the rules. There are 3 steps. Number 1, same day purchase, first priority. Number 2, following 30 days. Number 2, following 30 days. Use your brain, use your common sense. First of all, how many shares you sold? DP, you sold 350 shares. So you need to match cost of 350 shares. When you sold 350 shares, so you need to match the cost of 350 shares. Now read the date. What's the disposal date? The disposal date is 22nd August 2024. Now the steps are, the order is first same day purchase. Did you buy anything on the same day? Yes, you bought, and you bought 1200 shares. You bought 1200 shares, so you can easily match 350. When you bought 1200 shares on the same date, so you can easily match the cost of 350. So in this question, same day is enough. It just in the first step the question will be solved, because you just sold 350 shares, so you need to match the cost of 350 shares, and that's happened on 22nd August 2024. So answer is B. Answer is B. Next question, dear students, please. Jordan purchased ordinary shares in Birthday PLC as follows. So this, you on 31st July 97 you bought 500 shares for this. Then 31st March 24 you bought 1500 shares for 4400. On 10th April 24 this happened. Now the major thing is, the striking point is the disposal date. Always remember, striking point is the disposal date. So Jordan sold 500 shares on 15th May 2024 for 4500 pounds. Okay, so 15th of May 2024, this is the disposal date. So luckily all the shares were bought previously. See, 15th May 2024, there is no same day purchase. There is no same day purchase. You can see there is no same day purchase. There is no following 30 days, because the disposal date itself is 15th May 2024. So all these buyings were previous buyings. All these buyings were previous buyings, and all previous buyings goes in the pool. So you need to make the pool. You need to make the pool, and then you can calculate the cost. Hope you remember the 3 steps. There is no same day purchase, so ignore it. There is no following 30 days purchase, so again ignore it. So finally, shares from pool. Can you make the pool? Yes, you can. Just simply add how many shares? 500 plus 1500, 2000, 3500 shares. 3500 shares are there, and then you have the cost is, wait, it's going to be 1250 plus 4400 plus 4850. So it's 10,500. The total cost is 10,500. The total number of shares is 3,500 shares. Now this is the pool. Okay, this is the pool. Now how many shares you sold? 500 shares. Okay, so just remove the cost If you write disposal, how many shares cost you need to remove 500 shares. So can anybody calculate the cost of 500 shares? Yes, very easy. 10,500 is the cost of 3,500 shares. So 10,500 divided by 10,500 divided by 3,500 multiplied by 500. Okay, it's going to be 1,500. This is the answer. So the what amount of cost should be deducted in determining the chargeable gain? This is the answer. The cost of 500 shares is 1,500 pounds. The cost of 500 shares is 1,500 pounds. 1,500 pounds. This is very super easy questions, basic MCQs, if you have done the topic. On 31st August 2021, Fernando bought 2,400 ordinary shares at a cost of 6,600. This is the first buying. Okay. On 31st March 2022, company made a bonus issue. Very simple. So what's the treatment of bonus issue? Only shares column will be added. The other column will be. So if you make pool, number of shares, this is cost. Okay. So originally you have 2,400 shares and the cost is 6,600 pounds. This date is 2021. Then you will have 1 for 10 bonus issue. 1 for 10 bonus issue. 1 for 10 is 10%. So 2,400 multiplied by 10%, the new bonus shares will be 240 shares and the cost is 0. So 2,640 shares you have and the cost is 6,600 pounds. Now finally you sold 400 shares for 900. 400 shares for 900. Wait, DP of 400 shares, 900 pounds. Now can anybody calculate the cost? Yes. There is no same day purchase. There is no same day purchase in this question. There is no following 30 days. So just remove the 400 shares cost from the pool. So you will deduct 400 shares. And can anybody tell me the cost? Yes, very easy. 6,600 divided by 2,640. Multiply by 400. This is 1,000. Okay. So yes, you will deduct 1,000 from here. So you will have a loss, 100 capital loss, 100 capital loss. You will have a capital loss of 100. Okay. This is your answer. Easy question, not difficult. So my dear student, that's it for today's class. So best of luck for your exams and be active, do revision and be confident. Best of luck. Thank you. Take care.